Mark here from Cube Consultancy. We're back doing a podcast for a YouTube channel. We've got Tim Lambert and we've also got Liam, who's going to talk about mortgages today. So what we're going to do, we're going to fire a few questions, quick fire questions at Liam about mortgages, and we're also going to talk about the accounting, tax side of things, and Tim's going to mention about the wealth management and how that all feeds into the mortgage side and also the tax planning for us as well here at Cube. So we work very closely with both of these guys. Tim, you've probably seen before. He's been on a few things with us, which is great. Liam, Tim introduced actually, so he's newer to us, but we've started putting all mortgages through him in terms of limited companies and also sole traders. He's been very approachable and very professional. So we're going to now grill him on a few questions.
Correct. Fire away, boys.
You want to start first?
What do we want to know?
Yeah, an easy one. Can you help me understand the difference between a fixed rate and a variable rate mortgage?
Correct. So, proof is in the pudding in the such of a fixed rate mortgage is fixed, which gives the comfort and stability of knowing that your payment's going to stay the same.
Yeah.
Now, the variable rate mortgage, a variable term, is a slightly older phrase. Mm-hmm. The modern mortgage world is now called a tracker. It achieves the same thing. What it does is it can fluctuate and it can move around. So you don't have the stability that your payments are going to stay the same every single month, because one month you could be paying an extra £300 compared to the previous month. And a lot of the times this is linked to the Bank of England. Mm-hmm. So if that's fluctuating up and down, it works one of two ways. If you'd have done one at the start of this year, with the base rate going up, you're going to see a very steep increase. But then now we're seeing it kind of tilt the other way and rates coming down. More clients are going, well, actually, I'll go for a tracker rate, the old variable rate, go for a tracker rate, because then if rates do keep coming down, I'm going to capitalise on having that reduction. Mm-hmm. And a big bonus of the tracker rates now is a lot of them have no early repayment charges. So if you're thinking of selling the property in the next 6 to 8 months, you know that you're not going to be lumbered with a 2-3% early repayment charge, mm-hmm. which works well for a lot of clients. But then you also have to understand there's a risk attached to it. It's not all green and rosy and there's no early repayment charges and it's lovely. You also need to be aware that if for some reason the pendulum swung and things started going bad in the market, your payments are going to go up with that.
With the variable rate?
Correct.
Traditionally, what have people taken out?
Traditionally, it's a fixed rate. It's just stability. People like to know what they're going to pay because people like to budget. A lot of people will do like an Excel and they know what's coming in, they know what's going out. Mm-hmm. So a tracker or variable rate just gives too much instability for people. And you do get warning. It's not like it just comes out your bank account. You do then get a letter from the bank. If the base rate goes up, you'll get another letter from the bank to mention, oh, just so you know, your payment's going to be increasing. But the volatility people don't like, so they often hedge for a fixed and then try and, if they can, align their life stages with the fixed rates, where they'll go, well, we will stay here for 2 years now, and it will line up when the kids are this age, which means we'll then look to move because schools will be different. So the fixed is the most kind of commonly chosen one to go for, which I'm advising clients for. It's just stability, but then again, it's on a case by case. If someone tells me they're going to sell it next month, then we're not going to be looking at a fixed rate. It's going to be lumbered with a large fee.
Does that mean that the fix normally has a charge? Oh, right, okay. What sort of percentage is that?
So normally,
yes,
it's on a percentage base. So on a 5-year fixed, it is 5, 4, 3, 2, 1 as the years go on. So the first year is 5%, 4, 3, 2, 1, and then on a 2-year fixed, it's 2 and 1. So 2% the first year, 1% the second year. There's a couple of products on the market that you can have a fixed rate with no early repayment charges, but again, that's not widespread. There's 1 or 2 lenders that do it, and because of the risk aspect of it, the lenders kind of pop in and out with it. So it's not a guaranteed you're going to have it all the time, but it's definitely worth looking at because you get the flexibility of your payments staying the same, but you can sell it. And again, on the flip side, some people don't even want to sell it. If you're then expecting a large cash injection from inheritance, or you're going to sell another asset and you want to pay your mortgage down, then you look at more of a flexible option, whether it be, they're called flexed fixes. You try and find a flex fixed if you can. If you can't, look for a tracker so you can make a large overpayment without being penalised above, say, 10%, which is the norm.
I was going to say, the overpayment, it's normally around 10%.
Yeah, so for the majority of banks, it's a 10% overpayment facility. However, you have the likes of Metro and NatWest that allows you to do 20%.
Oh, right, okay.
Which is quite handy for clients. It's quite handy for clients. And obviously, it works out nicely if when the broker or the advisor then does the sourcing and NatWest comes up cheapest, and also that you've told them that you want to make an overpayment, it works perfectly. but it's also making sure you weigh up the cost, because you could say, well, a 20% overpayment facility sounds great, but if NatWest is really expensive compared to the cheapest option you can go with, you need to speak to the broker and actually weigh up the costs.
Yeah.
So on the face of it, sometimes looking at the cheapest interest rate isn't always the cheapest thing. Is that what you're saying?
100%, because it depends on your scenario, and it's why I say to a lot of clients it's transparency, is that I expect complete transparency from them and vice versa, because then I can actually give you the tailored advice.
Yeah.
Because if you're then going to mention to me that actually I've got some probate going through, I'm going to be getting a large cash injection, which you might have thought isn't relevant to a mortgage, just well, I'm just going to keep the money in the bank. Well, actually, if you thought about overpaying it, and then once you start the conversations and they lead on, it's actually, well, yeah, I was going to pay a little bit off. Well, in that case, then that's going to then steer the direction we're going to go. Because if it's going to be, for instance, say the top lender was Halifax, but they'll only allow a 10% overpayment, but the kind of figures we're talking about and rough ideas would be a 20% overpayment, we then weigh up the options and go, well, actually, look, for a marginal difference in interest rate, you can then get a 20% overpayment facility, which will then facilitate a lot more interest savings if you do make that payment.
You're literally saving clients thousands of pounds.
Correct, exactly.
Through your advice, which is great.
Exactly that. It's taking a bigger view of the picture. It's not just going, that's the cheapest rate, it's the one I want. It's looking at all the different scenarios in the client's life to go, well, actually, I can save you a lot more doing it this way, even though the rate's slightly higher, because you want to do X, Y, and Z.
Is it tough to get that over to clients and explain it?
I get two types of clients. I get clients that want to know everything, and I will dig deep into every single part.
Yeah.
And there's other clients that just go, I just want a 2-year fixed rate, and I'll take that as it is. So it depends what the client likes. I try and tell clients, I'm going to tell you everything, and you tell me when to stop. I'm going to give you all the information so you feel informed.
Yeah.
And at that point, you then either take it on board, or you go, actually, Liam, no, I just want you to get it done, and I still can, but I'd prefer to make my clients feel a little bit more informed.
Yeah, I think they're all the same, really.
Yeah.
You kind of go on and give them as much information, and it's up to them to tell you to kind of to stop when you're going too much.
I say to a lot of clients when I'm chatting to them is that the way I describe things to you, I want my clients to be able to go down the pub or be around with friends for dinner, and someone say, "Oh, you got your mortgage done recently?" And they go, "Yeah." And then someone asks, "Well, how did you do it? Who did you speak to?" It's like, "Well, I did this with Liam, and we did this, and we spoke about this, and he told me that if I did it this way, I'd actually be better off than doing it the way I thought I was going to do it."
Yeah.
I want them to be able to recite and understand what we've done, not just have a transactional, yeah, my mortgage was done, I'm on another fixed rate. I want my clients to understand what they're doing and feel informed.
Yeah, I think that's interesting actually, because the key to good advice, whether you be an accountant, a mortgage broker, wealth manager, is that you may be advising on something really, really complex, and they can understand it because you've simplified it.
Yeah, we always say, you get clients that say, I'm terrible with numbers, or I hate accounts and all that.
Yeah.
So over to you, and you just decide. But we always try and encourage them to know something about their business. Like most of our clients are owner managed businesses, so you might have a feel for it, and you might know what your debtors are, your creditors are, but you should know a little bit more. You should know the exact days, and if certain clients are taking longer, you might need to pressurise them or put some processes in place. And we always think you should learn a bit more. But,
Do you think because a lot of the companies you do with owner managed businesses, they're just focused on getting the work in and doing the work, so to them that's the most important part, which in essence it kind of is, but they need to still be aware of everything that goes on in the background.
I mean, we're an accountancy firm, and when we started, it was get your bills out and just chase down the debts. Now you start looking at what you're spending things on, but really we should have been doing that from the beginning. But when you're in the motion of starting up a business, it is get the invoices out, bill. That's your priority. Where really you should just slow it down. Use Xero, the accounting software that we recommend for most people, and use it for its full ability. You can actually track there. You can run reports on profitability and
It's
projects.
easy to use.
It's easy to use. It's made to be easy to use. All businesses now have access to Xero, so it puts more pressure on your accountant because you should be adding value. I always think of it as like a flat pack. Because everyone can go and put a flat pack together. That's your Xero. So everyone can do the bookkeeping. Really, if they put their mind to it, might put things a bit wrong, but your accountant's supposed to show you how to save tax, how to plan, and have an understanding of where you want to go.
I mean, you guys, as an example, one of my clients that I referred to you, and she runs her own business. It's very successful.
Yeah.
And after one of your chaps looked at the accounts previously from, shall we say, a more traditional accountant, not using tech, not using Xero, turned out that the accounts were perhaps not correct. Is that fair to say? And so there was extra tax was paid.
Not just extra, it was double. You
Wow.
know, this particular client overpaid corporation tax by $7,000.
Yeah.
And this is a one-man,
Wow.
one-lady band.
Yeah.
You know, it was starting out.
Big difference.
That's huge.
Yeah, 100%.
It's huge. And it was her first year. You know, your accountant tells you to pay your tax bill. You don't even question if it's too high, really. You think that that's the figure. You know, and we were able to go back and look at it. The error was, normally we wouldn't look at a previous set of accounts, but because none of the brought forwards made sense, we had to look at it. You know, I think we
Thank
did.
God you did, yeah.
Yeah, that's due to having working papers and knowing what's involved in each number. You know, if you don't have them, you know, you can throw a set of accounts together. You can do it fairly quickly. But if you don't have the working papers and that structure of being reviewed by a senior manager, partner, then things will be missed.
And does tech play a big part in that with you?
It's huge.
That is, would you say that kind of bridges the gap as to it makes your life a little bit easier, but it allows so much more in-depth analysis of what's going on because the tech's at your fingertips?
Yeah, well also you've got more requirements now. So HMRC could plug into a system. Now, you know, back in the day you'd have shoe boxes of receipts and they'd set a meeting up and they'd come. But now they'll say, right, give me the top 5 purchase invoices, sales invoices, and that should be at your fingertips. That should be literally attached to Xero, download, send it over, because a VAT refund is dependent on that being solved. So unless you can do it quick, your clients are going to be held up 3, 4, 5,000, maybe more.
Yeah, 100%.
So we've definitely encouraged technology from the beginning. We've had to learn on the job as well, because when you learn,
it's changing all the time.
It's changing all the time.
Yeah.
You know, there's so many plugins to Xero, to even Starling and banks like that. They've got the plugins for making your own invoices. How does that fit into the system? Now, the speed of getting bookkeeping and accounts done makes our life easier as well, because then it means we can look at it and look at the actual management accounts and say, have you thought about this? You know, when you're spending the hour you have a week on that client doing bookkeeping, you're not adding value.
I'm finding that traditionally with business owners, they would wait until nearer the end of their financial year to know what their profits were. Oh, and now we can do this. We can save corporation tax by going into your pension, into the pension. And it was a bit of a mad rush.
It's too late for me.
And from a cash flow perspective as well, they've wanted to delay that decision right until the very end because they don't know what necessarily the outcome is going to be. But with tech and with working with you guys, for example, where you're helping your clients see what their cash flow is, you know, what the invoices are, you can then project more accurately what that business is going to make over that year, and then we can start planning for saving tax.
Well, as advisors, and when you get a client, you want that client to be big. You know, it could be your flagship client. It could be the one that you quote in every meeting that you met in that first meeting and had one person. Now they've got 100 staff. You know, you just never know. But if you can be on that journey with them, it's in your interest. So if they go off paced a year down the line and you haven't reached out to them, who's really at fault here? You know, you're the advisor.
Yeah, 100%.
So, yeah.
So talking about businesses and property, do you work with many as a businesses that take mortgages out, or you know what's your split? And are you finding that more people are wanting to purchase property through a business?
Yeah, 100%. It's now, I think, money and things are becoming tighter, so people are questioning the traditional routes they would have taken. So now it's the case of, well, I've got 3 or 4 properties and I want to buy another. And then the conversation comes as to, is now a good time? Which no one can time it.
Are people still buying second and third properties? Because it feels like they're being put off by the way tax is set up, the way government is, you know, they're being discouraged. There's definitely easier ways? Obviously, property. We've all grown up in that with your parents saying, "Get property,
Bricks
get
and mortar.
bricks and mortar, get third, fourth, unbelievable." There's probably easier ways of doing it because of that tax. Because the way it works now is salary, dividends, everything else, and then rental income at the top. Now, where we live, and in Hertfordshire and around London, it's high rate.
Got clients that are getting taxed at 60%.
60%.
Because they're pushing into that higher earnings
100%.
bracket. And so I think what I'm experiencing are people maybe accidental landlords. They've moved out here and they've still got a place in London or wherever they originally lived, and they've maybe upsized and they've kept that because that was perhaps the traditional thing to do.
Yeah.
And they're looking at other alternatives. Do they purchase another property, or do I do that in my own name, or do I do that in
100%.
business?
Certainly, the last year, it's kind of fallen flat on its face, and there's two parts to it. One is the stress testing of the banks. The buy-to-let is higher risk than a residential anyway, because you're not responsible. They can't guarantee that you're definitely going to pay the mortgage because it is going to be based off the rent. So it is a higher risk, or they're going to charge you a higher rate than they would on a residential mortgage. Now, on the flip side, the other problem at the minute is that the cash flow is being eaten up by the high rates. So the way the banks are trying to counter that and still try and make it attractive is they're going, well, I'll offer you a lower rate, but I'm going to chuck a big old fee on your mortgage, which obviously you're going to be paying interest on.
Of course, the banks are making their money either way.
Exactly. So whereas traditionally it was then probably 1,999 for a fee, so roughly say £2,000 on a buy-to-let for a product fee. On the mortgage, you're now talking 3% of the loan.
Gosh, so that's quite a lot. Residentials sometimes are what, £1,000 for a residential?
100%. 100%. The maximum at the minute on a residential is 1,495 on a product fee, but you're now talking percentages on the buy-to-lets. And like you say, around us, all in Hertfordshire near London, where prices are so high, and a lot of people in the last couple of years have released equity out their property because it's been a good stable investment over the past 5-6 years, they're then realising, well, actually 3% of my 400 grand mortgage is a large amount, and you're never going to get that back. It doesn't go anywhere for you. It gets added to the mortgage unless you have that money to pay up front. It's then added to the mortgage, and then at that point you're then going to start paying interest on it. So what you thought was just a 3% fee, which was lumpy to start with, you're now going to be talking that plus interest, which for an advisor to try and advise a client as to, yes, you'll still make a little bit of cash flow, and you weren't going to make what you were, but you'll make a little bit. But I struggle to be able to advise you to put 15, 20 grand on top of your mortgage with no real purpose. It doesn't serve anything. It's more the case of, well, look, the difference between it is you go for a higher rate with a lower fee, your cash flow is minimised for the next 2 years. You haven't really got a lot. It might be just wiping its own face and covering itself. But at least if you have that for 2 years, you can then reevaluate where you are without making £300 a month, but then lumping 20 grand onto your mortgage. So it's trying to then look at each client scenario and go, look, is it really beneficial for you to still make cash flow but be adding on such a large mortgage? So it's the way the banks are trying to counter why the buy-to-let market at the minute is just kaput.
Yeah, and so then you have to factor in even more so than what you did previously. Okay, well, what are the tax benefits
100%.
of X, Y, and Z? And I suppose then you're busy setting up companies. If somebody wants to do it properly or start renting or having more properties, we've just said it's way better to have it in a property, I imagine, than... Why is that?
Because of corporation tax. Obviously, you only pay, as a landlord, the rent is automatic, it goes on your self-assessment. With a limited company, you pay corporation tax, and then whatever you take out gets added on. So when you're not working, let's say, that's when you might take all the income out. So you'll have to pay corporation tax either way.
But the corporation tax would be 19%
to
25%?
Up to 50,000 is 19%. And then you've got that marginal between 50,000 and 250 where you pay 26.5, which is, still...
It's still tax, and
still tax, but you can put more cost through.
Yeah,
that's the benefit. Where as not sole trader, as an individual, you're going to get no relief for your interest.
So say you're refurbing a kitchen and doing all bits up and stuff inside the property. Can you do stuff with that at all?
Yeah, so that would go through the limited company. We would also go through as an individual, but where you're paying the interest, that is allowable within a limited company. You probably won't get the relief as a person.
Yeah.
You can also then any profit, effectively, you can then invest that into your pension, and that saves you corporation tax as well. So
there's lots of things.
Business expense.
Yeah, you might have some admin staff that are helping with running it. There's lots of things you can do.
I guess the flexibility of it is a big pro on the flexibility of a limited company is to you can kind of chop and change and decide what you're going to do. Whereas, like you say, with an individual name, it's just lumped straight away.
Well,
once your income.
If you sell that as well, obviously you pay 0.5% stamp duty if you're buying that company. So the thing you might need to think about is you might need to move some of them properties into individual companies and then sell it on. But you'll also need to think, if you go and look at a house, you're looking at a house. So if someone said, okay, it's actually in a limited company, so you're going to have to buy a limited company. Most people who are looking for a home for their family won't want to do that.
Yeah.
But when you talk about the investment in a second property, and we're talking about being expensive, are you seeing more people who live abroad? Obviously, lots of people are moving out to Dubai, Saudi, Spain, wherever it might be. Are you finding there's a lot of people out there that are looking for finance to buy a property here in the UK, and is that even possible?
Yeah, 100%. I think the more people we're seeing going out to places like Dubai, Australia, other places that they'd prefer to be in, they've
still got, if they're from England, they've still got that, have an English property,
It's kind of old habits die hard. They still feel it's safe to have a property back here. So some people, if they move abroad, then by all means, then you just then look at options as to, well, it's then going to be buy-to-let mortgage, and you've got the likes of HSBC and NatWest International are the two big players in expat mortgages.
Extra rates, I'm guessing, higher rates?
Slightly higher rates on the international side, but it's not jaw-dropping.
But they're okay with people, that are tax resident in Saudi, let's say, for example. They're okay with that, and home address? They'll still get through it? Okay.
Correct, yeah. So, like I said, you're very much dwindling your options as to not a lot of banks do it, and sometimes you have to go to the real specialist banks that will accept it. But the two big players are the first kind of places you look would be the HSBCs and the NatWests.
And what income would you have to show? So if you're reporting your income in Dubai, is it...
It would be very large, I imagine. If you're in Dubai in the first instance.
Is it bank statements, or are you asking for a Dubai accountant to give you a reference and tax returns? Do you know?
This is the hard part, because of every country having a different setup in terms of proving income. It then kind of narrows down the bank you're going to go to, because some banks are more comfortable than others with different countries. So it all depends as to where you are, where the income's being declared as such, as to then how we're going to prove it. Because it might, Swiss francs for instance, might work with HSBC, but then it might not with NatWest. So you need to know which banks accept which type of currency and how they're going to want it proved, and also what you do for a job. Because if you're employed in Hong Kong, we can just show some pay slips.
Of course, yeah.
Whereas if you're then going to be a sole trader in Abu Dhabi, it's going to be a completely different tax document. So it's getting the advice and having a chat with an advisor, and it's a very niche market. But it's becoming bigger and bigger.
I suppose bank statements are bank statements, though. Provide us with a mainstream, equivalent of a mainstream bank over there. It's going to show your income.
100%. It's reliable, and the good thing is as well, a lot of the big banks, the likes of HSBCs, will do the international stuff. If you bank with them, they can see your bank statements anyway.
Fine.
Which one works good from a compliance perspective, because you can't put the wool over anyone's eyes. Because if they see a discrepancy, it will flag instantly. But also makes the processing a little bit easier.
Yeah, of course.
Because they can automatically see, when we do the application from our side, we'll put in, are you an existing customer? You'll put the sort code and account number in, and it'll automatically log it, so they can check. And it sometimes get approved a little bit quicker.
Nice.
Because they can kind of cross-reference straight away and see.
So that whole matching of lenders to overseas people, that you must have similar with matching of owner-managed businesses.
100%.
Is there a preference? Has there notoriously been lenders that work with them? Have you seen new lenders change their rules and go back to now working with owner-managed business? Not the vanilla mortgages.
100%. I get a lot of clients that, for instance, they're running a limited company and the company does quite well, but their personal lifestyle, they don't need to take a load out of it, and they're also not then going to pay a massive tax bill on something they don't need, just to be able to take money out of it.
This is a big thing. I mean, this is huge for my clients, probably yours as well. I mean, lots of people are going to be asking about this, because they are going to think, right, well, I need to have a big build up to a certain year where I need to just take loads of money out, pay masses of tax, income tax as well, which we know is huge, in order to get a mortgage. So I know the rules are kind of changing on that, and you can leave the money in the business, but you're entitled to a dividend. but that's going to be reflecting on the rates they pay, right? It's going to be slightly more.
100%. It's a really interesting angle to take on having an owner-managed business. If you're a limited company, for instance, you could be pulling out 50 grand in terms of salary and dividends a year because that's what you need to survive, but the company profit is actually looking a lot healthier. For instance, I had a client who's the profit for the company, the net profit was about 280, but he took 50 because he was like, I don't need the extra money.
So what could he borrow as a multiple, typically? I know
as a multiple,
changes in
correct. As a rough guide of thumb, you'd say 4.5 times income would be the rough idea.
Of the net profit.
Correct.
Okay.
So then it then goes into another realm as to when we calculated what he could borrow based off of his salary and dividends, what he'd pulled out the company, he could afford about 300,000.
Yeah.
We then looked at his net profit, he could then afford about 600,000. You then looked at his gross profit after expenses, he was then reaching up to 800,000.
Wow.
So all it is just a slightly different look on the perspective of the case and knowing the client and the transparency with the client that makes a massive amount of difference between looking at your salary and dividends versus looking at the net profit. And a lot of banks are now coming out and they want a kind of slice of the pie in the market. So the big players you've got are Virgin, Clydesdale, Metro Bank, they like the profit side of things. Accord quite like the profit as well. And Halifax. If you're...
They've been the traditional one, haven't they? Halifax being on the scene.
Correct. And they kind of dipped out of the net profit side because everyone got a bit shaky with self-employed, especially around COVID. And they've now come back into it. And if you're in the large loans kind of team, so if you're over £500,000, the underwriters will take a view on your net profit. And Halifax at the minute are one of the top lenders and notoriously have been for many years. They're a very big lender and they like lending money. So they're always going to be around the top. So if you know that you're going to be over £500,000, but you're not taking much out of your company, but the company's doing well, just ask for a slightly different view on it and look at the profits instead. But not a lot of people know it.
What would the difference in rate be between when you said he qualified for 300,000 and when you say he qualified for 800,000? What's the roughly? How much of an increase?
It's pretty much the same.
Right. Okay.
You're not kind of levied any extra at all for going through this net profit route. It's purely going to be dependent on the sourcing his cheapest rate at the time.
And the loan to value as well as a big play.
Exactly that.
Yeah, of course.
So he was 75% loan to value, so he had a 25% deposit to put down.
Yeah.
So he was kind of getting the creme de la creme, the really good products.
Yeah.
Virgin, for instance, if you're sourcing for a client and they come up top and you also need salary and dividends, then great, because you're getting the cheapest and the best on affordability. But sometimes it might be the case that I know from a client looking at his documents, I'm going to have to go down the net profit or the gross profit after expenses. So then it might not be the cheapest, but it will get them what they want within reason.
Fine. And there's some professional mortgages as well, right? For accountants, lawyers, architects.
Yeah.
Where, is that, do they get less loan to value or is it more multiples of profits? How does it?
You get a slightly more generous affordability.
Right, okay.
Because from the bank's perspective, if you're in a professional occupation, they assume your income's just going to steadily increase. Say a trainee accountant's on £30,000, but once they're qualified and they then go up and they start then obtaining more clients and growing, the banks understand that even though right now they're on 30, in that occupation you're going to grow, you're going to pick up clients, you're going to earn more money.
So you'll get that as a trainee, not even qualified?
That's where then the technicalities come in.
Right.
So certain lenders want to see you qualified in the industry but starting out. So for instance, you could go and get your certificate in mortgage practice and then straight away you're then eligible for it, whereas if you're training for it you can't. So
Right,
then it
okay.
becomes very niche, but it's definitely something to explore because it can make a big difference.
So doctors, would that work?
Yeah,
as
doctors,
well?
yeah,
Yeah,
100%,
they are,
yeah.
yeah.
Solicitors,
Yeah.
like any professional job as such.
Because doctors, unfortunately, we hear that they don't, when they come out of university and they've done their training contracts, they don't traditionally, or they're not getting paid particularly much. But
Yeah,
there is a significant rise in earnings over time.
yeah, 100%.
So
And
you can help doctors get a mortgage that might be more appropriate based on
100%.
their future earnings.
It just takes a bit of an alternative view on it. You can never promise a client you're going to get them X, but it's just taking an alternative view, because if you take the traditional view of whatever your salary is 4.5 times income, you're going to get a figure and you might not be happy with it. Whereas if you actually then start looking at different options and go, well, actually, you're a professional, so you qualify for this specific interest rate with this bank, and they'll lend you 30, 40, 50 grand more than the rest of the banks were going to, because they understand the job you're in and where you can then go with it.
Is there any particular sectors that are difficult to get mortgages through?
Not particularly difficult. Some you have more challenges than others. You have sports people, obviously, who are going to be limited on the term.
That was going to be my next question. So
Yeah.
how does it work in terms? Is it to the end of the expected career, or no, do they pick an age? Let's say 40.
Yeah.
Is
So,
that what they do?
So dependent on what their career is. If you're a footballer, they can go, well, you might be able to go to 40.
Okay.
Normally 35. If you're a boxer, it's going to be around the same of age 35.
Right.
Anything physical, any professional player, which is a kind of a high intensity physical sport, you're going to be limited to around 35. Some lenders will go more.
Fine.
But then if you're a snooker player,
Oh, so they'll take it sector by sector depending on the industry. Okay, right.
Correct.
Fine.
And because normally the loan size you're going to be looking at as an athlete, you want to be buying a nice size house.
Yeah.
There's flexibility to the bank where they go, actually, well, look, realistically, he's a snooker player, he can go till he's 50, he's going to be fine. Whereas Mr. Jones, he plays rugby, he isn't going to make it to 50 playing rugby every week.
But when you look at them, so you look at footballers and rugby players, it's a set wage. But you look at snooker, it's prize money.
Yeah,
Boxing, to a degree, is the same. How does that get worked out? Is it an average of 2 years, or?
Yeah, be the same way
Is
as
that
any
what it-
self-employed
really?
person
So
does,
like
yeah.
self-employed earnings.
Average
Even
of
though
that-
it's based on prize money, it's right. Wow.
Consistency is key now.
Better
for
keep
sports
going.
people,
Yeah.
The other part with athletes, sports people, they generally will ask for a slightly larger deposit. You won't be able to do it with the 5% your average person can,
Right, fine.
because again, it's high risk. And it goes back to your point as to the income's there and it's provable, but it's not regular. It's not every single month you're going to be getting paid the same basic salary. It is going to be a prize pool winning as such.
How much do they take into account investments? Because I work with sports people and we are obviously planning for the future. So with a finite career, sports people, potentially actors and actresses, Instagrammers and models, those kind of industries, where when I'm sitting down with those clients, we're planning for the future just in case. And how do we maintain your lifestyle once you finish playing or doing what you do?
Yeah.
So building up this pot that can help with their lifestyle and also pay off potentially the mortgage.
Yeah.
Does that factor into getting a mortgage as well? Or how much do they say, right, well, you've got 1, 2, 3 million of savings here that could grow, so we will lend you more, or we're happy.
Yeah, 100%. They're going to take it into account. It's, again, when you're talking very kind of niche scenarios, because a lot of banks like vanilla clients, Mr. and Mrs. both employed, happy as Larry. When you start talking about more niche aspects like sports people, like investments, a load of the banks will look at it. Metro is a big player in taking a slightly abstract view as to, all right, look, you've got that in an ISA, you've got that in a SIP, you've got this here, you've got that there. Let's amalgamate.
Oh, right. That's
And
good.
they won't take all of it. They'll always say take about 25% of whatever you've got. But we look at that in either as an affordability perspective to go, well, actually, we'll lend you a little bit more because we know you've got that additional income and it's plausible over the next couple of years. I helped one of Tim's clients that was looking at raising some additional money, and to facilitate raising the additional money, we had to have another element of her loan on interest only. And so we then used and started looking at her ISAs and her pensions as to, well, she has that cash there, so she has her allowance if she needs to pay it off. She's got that set amount there already. So the bank's perspective was, well, we're happy then because, one, the asset can be sold, and two, she also has pensions and other investments in the background that will kind of underpin and support lending on the property at the same time.
Okay, nice. Would it work similar to, so the footballers obviously get their salary, but they've also got limited companies for image rights. They take that into consideration as well.
Yeah, 100%.
Nice.
Yeah. The banks like to be similar. They like to just look at a tax calculation, but then equally if you give them a slightly different scenario and go, well, look, well, his basic's this, but in his company he hasn't really pulled anything out of it, but is actually showing a really good turnover of profit there. Can we amalgamate the two and use both of them? 100% they'll take a look at it. Banks want to lend, but you just have to be a good storyteller, is what I tell clients, is I have to tell a story about
Paint
you.
a picture of who that person is. And
Exactly, because you look one way on paper and then I paint a picture and actually explain your scenario and explain your income, your expenditure, and I make it simpler to understand. because when you look at something on paper, it can be a little bit confusing as to you've got money coming in from here and there and there. And from the bank's perspective, they go, well, what should I use? Because it's all a bit here, there and everywhere and messy. So my job is to go in there and go, well, look, he gets this amount from his image rights, he gets this amount as basic salary, he gets this amount as a bonus. He's had that for the last 4 months. So we're going to look at amalgamating this and using all the different streams of income to then facilitate what they want to do. So storytelling is a very simple way to make out what I do.
I mean, one thing that they definitely don't teach in schools enough for me is like your credit score and the importance of your credit score. Until you start going for mortgages and things like that, any sort of defects, you know, for me, what I've experienced with people that we've got mortgages for is if computer says no on that. You know, you can have your loan to value, you can have your earnings, but if you've got a default or a CCJ or something like that, you will not get past the first door. So
correct.
You know, that's definitely not taught to people. We've got so many real successful people and their experience score is like rock bottom. Some of them can't even get decent current accounts for themselves personally, but also for the business. So from your point of view, because lots of people will be out there looking and trying to get houses, can you just explain how important the credit score is?
It is probably the most important part of getting a mortgage, which people don't understand, because like you say, it's computer says no. If your credit score is bad, you will hit that first blockade, and the system, even though your income looks great and like you say, got a big deposit, if the system automatically classifies you as a high-risk client because you've got missed payments, defaults, CCJs, things like that, you can't even then vouch your case to say, well, look, I do have the income, and it was a couple of years ago, and now I'm better. The computer says, no, you're out then.
Yeah.
So
is there any lenders that will consider you?
Yeah, 100%. Yeah,
but you're going to pay?
Correct, you're going to pay an increased interest rate, because again, all banks, they work off risk.
Yeah, of course.
You're high risk to the client. You haven't shown... Your credit report is an online footprint of how you conduct yourself with money, and you haven't given yourself a good account. And it's simple things like I've got a missed payment on a credit card because I didn't realise the direct debit wasn't set up correctly. Even that has an impact. It could be the case of, I got a parking ticket and I never paid it because I thought it was a joke, or I didn't agree with it, I shouldn't have got it, but then got to a CCJ stage, and then that's a big old tarnish on your credit report. So it's trying to take it all seriously, but you've got so many banks out there, lots of Kensingtons, Peppers, Togethers, Precise, that will take a view on it. And again, it highlights the value of an advisor because each bank has a different criteria. So you could instantly say to me, I've got a CCJ, and I'm going to be thinking, okay, well, if that's your general conduct with money, we're going to have to look specialist ways, X, Y, and Z. Once I get a copy of your credit report and I go, actually, there's one CCJ, it was from 3 years ago, it was for only £200, you satisfied it the day you got it, I can actually probably now get you back in the high street because your score's improved again. Correct.
So you can use that, so you can take the hit initially, and assuming that you continue to pay it and everything's on track, then actually that will benefit you.
100%.
But that's because you have an advisor that you go to within NatWest, let's say. So if someone was at home doing a mortgage through the NatWest website, it's probably going to be rejected because of that CCJ.
100%,
But you're able to speak to someone.
Yeah, so I've got contacts in all the different banks.
See, that's the difference.
So it's the case of that I can look on, and everyone can find the same websites I look on, but I have the contacts in the bank to give them a call and go, look, this is my scenario, and they go, look, based off the loan to value you're at, the CCJ isn't that high, or the default was only for £30 on a phone bill, you're probably fine. Now, it's always subject to credit score.
Yeah.
But there's people in the bank that I call and I speak to that I then run the scenario, and they work there and they know the criteria inside and out. They do it day in, day out for one bank, and they'll go, yeah, give it a go. And that's the difference, because you can do it yourself at home and start pinging your name to loads of different lenders and go, well, I'll do it myself. And then it gets declined, and then you go to someone else and gets declined.
That affect your credit score as well? If So
that's a hard search,
creating a problem for yourself.
So decision in principles are often a soft search, so the equivalent to a car insurance quote as such. But if you then get to a full application, it's then going to be a hard search. But it still all makes a mark, and the banks all talk to each other. So the banks have something called a hunter report, and what that is if you start submitting to different banks with slightly different information, and it could be £2 off on an income figure or £7 off on the credit commitment versus what's actually on the credit card. They start talking to each other, and then start building up a picture and going, well, you told me it was that, but then you told him it was that. What's the truth here? And if they see you searching with multiple lenders, the question will most probably arise to say, we can see you've searched different lenders. Why have they said no? Because if all the other banks have said no, the bank you do go to that start to accept it, they then go, well, are we missing something here that they've already picked up on? So the value of the broker comes in, where they don't start putting you around different places.
Yeah.
They do the research and put you in one place they know you're going to fit, instead of you potentially ruining your credit score by doing it yourself and going around to different banks.
Value of a good accountant as well, so that you know exactly what your earnings are, what your dividends are drawn, what you're on track for.
Yeah, working with a good broker, honestly, it makes it massive.
Yeah.
Well,
that's why I work with you. Isn't
Makes
it?
it
massive.
Back to the credit. Is it Experian or Equifax, or do they?
All of them.
Right.
All of them.
Okay.
So I always say to my clients is to use a company called Check My File.
Oh yeah, that's
And
right.
the reason we use them is because they check all the
All of
different
them.
credit agencies. I think there's 3 or 4 they check. It's Experian, Equifax, TransUnion, I think someone else.
Yeah, I mean, I would definitely encourage, because that, I don't know what it costs. It's like 10 or maybe 15,
Tenner, yeah.
10 a month. I would encourage most people to do that.
Yeah.
It happened to me with an old Vodafone. I had nothing. I didn't have any idea, and I paid it obviously. But to get that removed,
The faff.
it was an absolute nightmare.
Yeah, 100%.
Yeah. For like, I think it was like £17.
And all the banks use different credit agencies. So your
okay.
Equifax might not have shown you had a missed payment.
And
but your-
completely different scores. Like
Correct.
Equifax and Experian, are completely like different
You've
scores.
got 2 different pictures of yourself.
Yeah.
Your financial footprint is completely different, because one credit agency will pick up you got missed payments, the other one won't.
Yeah.
And then the bank you go to, different banks use different agencies.
But it's also consistencies, that they've got your correct address.
That's a major factor.
Things like that.
Yeah.
Electoral rolls, make sure everything matches up.
Well, it happened to a client of mine literally last week. I was having lunch with them. They're buying another property, and they've got 995 on Experian, which is the best one. And the broker came back, who they were using, said, "Oh, sorry, it's not come through, because TransUnion had a different address with a London flat."
Yeah.
To the one on the other file, because sometimes it will be, say, 43 this road instead of this road 43, and just that tiny discrepancy then meant that something was missed off and it didn't match, and computer said no.
I see it a lot. You'll have a lot of it, unfortunately, is for clients in flats. It will be flat 3, 7 Worcester Road, but then another credit agency will have it as second floor flat, Worcester Road, number 7. So the address is the same, but it's entered slightly differently.
Yeah.
And it's, again, if you're applying for different forms of credit, or you've got bank accounts and a credit card, make sure the addresses match. Make sure it matches the electoral roll, because if it's slightly different on each one, it makes it hard for the bank to track you consistently at that location.
Expect a call from my client tomorrow. See if we can rectify that. But that's the thing, they did it. It wasn't to know that they were applying for that particular thing at that moment in time.
But Check My File, I'll always recommend my clients to use it, because it checks all of them. Because like we say, your financial footprint can be completely different depending on who you're looking at. And you don't want to waste your own time going to a bank that uses a credit agency that sees you as bad, because they're not picking up on the other things, because they might not have updated their electoral roll that you're there. So this Check My File report shows you everything, so you can notice the discrepancies between them, and then get in touch with Check My File and go, well, actually, I am registered here. Can you ask TransUnion to update it for me? And they'll do it all for you.
So what are the top 5 things, very quickly, the top 5 things that you would say generally lenders look at for an individual or a business owner, just generally?
Generally.
Credit record is number 1.
Credit rating is going to be number 1. It's going to be, have you conducted yourself in terms of the way that you've dealt with the money. A couple of things within inside the credit report as such is to make sure everything's paid on time. Try and stay below 30% usage on any credit cards you've got, because if you start going over that, they'll then start worrying that, well, you're living a bit outside your means, you need to borrow money. Be on top of your books if you're a business owner. Make sure that you know what's going on in the business. Make sure you know where figures are projected to be, because you don't want to get your dreams and hopes up on, well, my business is doing really, really great, and then you come to doing your accounts, you have a conversation with Mark, and Mark goes, well, actually, no, because it's declined because of X, Y, Z reason, and you forgot you got to pay this tax bill because you wasn't answering my phone calls. So it's staying on top of your accounts and making sure you know where the business is heading. Be proactive as well as the biggest thing. If you want to buy somewhere, make sure you're speaking to people early. Speak to an advisor, I'd say 6 months before you want to buy, and just say, look, am I in a good position? Because what you don't want to do, and a lot of clients do, is they come to me and go, I've been given your number by so-and-so, he said you're great, and he said you get me a mortgage. So I'll take the Pepsi challenge on anything. I'll say, I'll go on then, I'll do it. And they send me their credit report and they've got missed payments, not only electoral, their accounts are wrong, they've declared no income, and it's just a very ugly picture. And they go, well I have earned more money. It's like, well, no, I don't know that. I can't see that. You can't prove that. So get in early, start prepping and seeing the long-term vision to go, look, if I want to buy a house later on this year, let me speak to someone. Let me speak to my accountant to go, look, where are my figures looking? Because if I speak to a mortgage advisor, can I give them some rough ideas as to where I'm heading? So being proactive with it, in the same way if you're remortgaging, be proactive. 6 months before your current mortgage ends, start speaking to advisors. And you feel free, you can go around and speak to multiple advisors and have a chat with them. Just don't do any credit searches whilst doing it. And also take a holistic view. When you're doing a mortgage review, don't just see it as, I'm doing my mortgage now. See it as, okay, well now let's have a look at my overall picture. So my mortgage is done, let's look at my life insurance. Is that where it needs to be? Have I got a will in place? Because if I've got a couple of kids, is my will in place? Do I have a power of attorney in place if things happen? Have I made sure, have I got any cash I've got in the bank? Is it being pushed in the right direction? Should I be putting in X, Y, and Z? My pension, where's that? Because if I want to retire at 67, I need to make sure my pension's set up correctly and I contribute through work, but I don't know what happens with it, or I put money into a pension. So view it as a holistic kind of financial review, and at that point the broker can then go, well look, have the conversation with Tim, have a conversation with Mark, have a conversation with Steve, and you take a whole view on your finances, not just, I need a new mortgage and it's going to be expensive.
I think that's why we work closely together as well, right? Because I think people sometimes think, oh, you do that, so that's that. You do that, and they're separate, but they're not. They are very, very mixed.
Yeah, the whole will side of things is obviously we know Steve Bish. And even myself as an accountant, I've now started seeing the importance because I've seen it go wrong. For people. So that's you, or you must know even more than me. So the importance of putting that in is key.
First thing I recommend to clients, actually, one of the first questions is when you have you made a will. I don't do that, but it's something that I recommend people straight away and then refer out to get it done, because it's all well and good buying a house or doing your accounts or planning for the future from a financial perspective, but if you haven't got a will, it's all built on sand should something happen, because unfortunately you're in a mess.
You plan for the worst and you hope for the best. I think a lot of people think, I don't need it, it won't happen to me. I'll think about that when I'm 60, 70, when I'm, when I'm later on, I'll then get it in place. But I've had it with clients where they call up and I've arranged some life insurance for them, and very fit 35 to 40-year-olds, and they've called me and said something happened. Either one of them's passed away, they've been diagnosed with something, and they never think it's going to be them. But it is. So even though it might be boring or it's time consuming, to have that holistic view, to start looking at wills and everything else, I think it amplifies getting advice from, if you can, professions that work together and know each other on a good personal level. It's all in harmony, because one, it speeds things up, because if you refer a client to me and say Liam needs a mortgage and his accountant's Mark, I can reach out to Mark and Mark sends me what I need, and vice versa. If I need to start seeing savings statements and investments, I can then go, well Tim, can you send me their portfolio spread at the minute, because we're going to look at that side of things, and it all works in harmony, and I can then tailor into the fact Mark goes, well look Liam, this is where the business is heading, so this is where it's going to look, which changes my advice, and I can then let you know how that changes, which changes your financial planning. The harmony, when you have people all working together, instead of, like you say, splitting up, people going, he's just my mortgage guy, he's just my accountant, he's just this, makes a massive difference if everyone knows each other.
Very true.
Makes me do a better job if I know that my client has a handle on their accounts and their mortgage, because they then know what their expenditure is, affordability is, and we can then plan for what can we save going forward. How do we pay off that mortgage quicker? all that kind of stuff. How do we save tax from a business perspective? So it is very rounded.
Have you seen that more recently with clients now with rates going up? They're going, I want to start getting my mortgage paid off quickly. And is it actually the best? Is it the best thing to do? I think that's the general mindset: is get your mortgage off, get it paid quickly.
Yeah, in terms of people getting in touch and clients asking, what do I do with my cash? Do I pay off my mortgage or do I invest? Before, when interest rates were lower, it was a very, very easy thing to say, well, over the longer term, invest because you're going to beat 5%, beat 1.5%, which is what the interest rate was. But now that interest rates are at 5%, it is a lot more around tax planning, long-term planning, what are the investment alternatives versus paying down the mortgage. So as long as the interest rate of growth that you're getting is greater than the interest you're paying on your mortgage, you're winning. That's the simple way of looking at it. But then also when you factor in tax, so by investing, am I also saving tax? Saving for the long term, building up a pot which could then be used to potentially pay off some or all of the mortgage, then again, that's factored in the planning as well. Sometimes it's easier to just pay off the mortgage. And for peace of mind, for some clients, I do suggest pay off the mortgage. You're saving yourself interest. You know what you're doing in terms of saving expenses and everything like that.
I guess it just goes against the norm. It's having the outlook to actually think about different options.
Yeah, it's the flexibility, right? And so, and it's also, I say, financial planning is a little bit like marriage in that, sometimes you have to compromise, and maybe it is better to compromise. So rather than paying off all of your mortgage with the spare cash or all investing, it's about just taking a step back and being like, right, well, maybe we do put some there and put some there. And that creates flexibility over here rather than tying up all of your money in an asset. Whilst also, if changes in rates were to happen again, you haven't invested all the way over here, or markets have gone down and missed, or lost money there and not paid down the mortgage. So again, it's very fluid, but I've never been busier from an advice perspective because of the volatility that we've seen in the markets and because of the
100%.
the rise in interest rates. So more and more people don't know where to go or what to do. And so we may not be necessarily investing more for a client, but we're certainly adding more value by saying pay down your mortgage here and maybe do something here. So it's been a very interesting year. It'll be interesting to see what happens going forward as well with tax changes and potentially a new change in government as well. I think all the more reason for advice, both getting advice to know where you are now, where you want to be in the future, and how do you get to that point, as well as navigating all of the changes that the world and life throws at you. And I think that's definitely what I add value to with my clients, and I know for a fact you guys add value.
100%. I think us three see it in all of our industries. Everything moves so quickly. What I was telling a client to do 2 years ago, the criteria has now changed on that, so they've got to fit a different little box. Everything changes so quickly.
I'm getting flashbacks to COVID.
Of course.
What happened then, and then Liz Truss with her interest rate. It's just been mad. The last
it changes so fast that it then provides more. You can provide so much more value to a client because that's your life. It's what you do for a job. All you do is you have eyes on the market, so you follow it. Whereas if you try and do things yourself, you might have a good return at it, but you can't have eyes on everything at one point. So for just someone as a sounding board getting some advice means that you don't have to worry about watching everything that goes on, and you can trust that advisor to deal with it for you.
My client, who I had a meeting with this morning, and he is immensely intelligent, and frankly he's more intelligent than me, but my client basically has done extremely well, works in the city, he's about 50 and he earns a lot of money. But he said, I haven't got the time or the inclination to be able to focus on this now, and I trust you to be able to look after this and help me plan for the future. And he knows that if he had the time, he would be able to study the changes, study the markets, study what tax reliefs there are, and implement that stuff himself, but he doesn't have the time.
Mhm.
And so that's why he trusts an advisor.
Yeah, place reliance.
So,
yeah.
you know, you get many people who maybe think, oh, that they can do it themselves because undoubtedly they are intelligent and they are good at their profession and they may
100%,
work
yeah.
in a field similar to that or partly do that. But unfortunately, time is very precious.
Yeah.
And knowing the little chops and changes that may add that value can sometimes be missed out on. So by getting advice, you're getting so much more. You know, it's our job to create value and help value, and that's definitely something that I found as my career has progressed and as my clients come.
100%.
Right, here we go. You first then.
I'm not
So we'll
gonna
do you.
control
We'll
that.
do you,
Yep.
and you got to do quick fire ones, okay?
Cool.
So, what insurance do you recommend for my mortgage?
Personal to each client, but as a basic standard, make sure you've got buildings insurance because that's a condition of the mortgage, and also make sure you're looking at life insurance and income protection or family income benefit as well.
Cool. What is the difference between a mortgage broker and a lender?
Mortgage broker is a middleman, so we're known as intermediaries. So the mortgage lender is the bank, and I'm the middleman between you and the bank to try and negotiate the best deal with you and the whole of the market. So I'm the middleman.
And does it cost more to go to the bank or to a broker?
You go to a broker that doesn't charge a fee like me, and I don't charge a fee for my services, so it's exactly the same as if you went straight to a bank, but you just get someone's eyes on it.
And potentially a better result.
Exactly that, yeah.
But the bank pays you, right?
Correct, I get remunerated from the bank. It's not strictly a commission,
Yeah.
and it's completely separate to the client's mortgage, so they don't ever pay me, it doesn't ever come back through their mortgage.
But it gets shown on the documents, right?
Exactly that, so
Yeah.
everything that I send the client will say, Liam Stanbridge will get paid X amount of money.
Cool. Where are you getting these from? Questions from? Mine are all like.
Sent them, did you not?
You're-
There's three lots.
No, he's just got the accountancy questions.
Oh right, I was thinking, where's he getting from? These are amazing questions.
So, with loan to value,
Yeah.
quickly explain loan to value, and at what point does that benefit stop?
Loan to value is the loan in relation to the value of your property. So if your mortgage is high compared to the value of your property, you're a higher risk because the market only has to drop marginally. The property market has to drop marginally for you to touch negative equity. So the lower your loan to value, so the more equity you have, you'll get a better deal generically, and it tiers down in 5%. So if you have a 5% deposit, you'll get an okay deal. If you have a 10% deposit, you'll get a better deal. 15%, it'll be an even better deal because you're more of a security for the bank that there's a bit more margin in your equity.
What's the typical timeline for mortgage approval?
Typical timeline. Well, I'm going to go out on a whim and say last week I had one new purchase case offered in under 24 hours, but that's not the standard, so no one hold me to that. But I'd tell the right clients roughly I'd put aside 3 weeks for the bank to go out, do the valuation, assess things, come back with a couple of questions. But that's a conservative 2 to 3 weeks.
Can you offer advice on choosing between a repayment and an interest-only mortgage?
I can indeed. So again, another rabbit hole you can go into, but in essence, repayment mortgage is every payment you make per month. A portion of that payment pays the interest on the loan, a portion of it pays off your mortgage, versus an interest-only loan, you're only paying the interest. So your payment can be a little bit less, but you're not paying the mortgage off each month. Your balance will stay the same for the whole time. So for different clients it works, sometimes it doesn't, but yeah, I have clients all day long that some prefer interest only, some prefer repayment, but it's different horses for courses.
At the moment, with things being a bit more expensive, how are people saving on their mortgage? What are they doing to either reduce or keep their mortgage payments similar?
So when interest rates are high, interest only doesn't particularly serve much of a purpose. Before there'd be a really big saving per month on interest only, whereas now that margin is becoming thinner and thinner. So the client weighs up, well, for 2 years I'm not paying anything off my mortgage and I'm not really saving that much more per month. So they then look at extending the term if they can, but then you do have to remember if you're extending the term of your mortgage to bring your payments down, you will pay more interest over the long run because you're spreading that mortgage over a longer period of time. So that's what clients are trying to do at the minute, is find that happy medium between extending it but not paying way too much interest than they really need to.
Yeah.
Quick fire question for Mark.
Okay.
What is your fee structure, and are there additional charges for specific services?
Yeah. So we've got a pricing tool that we use where we'll ask a series of questions depending on turnover. Again, we're talking about risk. We base our risk on that, on the turnover. And then we'll break it down into each section. So bookkeeping, if you want us to do it, raise invoices. We can do kind of anything where we're a complete outsourced finance team. I tend to price up everything I think a client needs and then highlight the other services so they can either come back later or they'll think, actually, can you give me the price of that now? And then that will come up with a monthly figure which covers them for the year. We want to be that accountancy firm that at the end of the year, normally we've got to deliver a corporation tax or an income tax bill. And the last thing you want is another bill
Accountancy bill on top of that, yeah.
If there's specific pieces of work, as an accountant, you have to have engagement letters. So if you ask for a cash flow or a specific piece of international work, we'd have to do an engagement letter, which means you have to quote for it. So in essence, we would price up any additional work that way.
What documents do I need to start preparing for tax preparations with you? So what does a client need to bring you?
So for sole traders, I'm encouraging all sole traders to put all their sole trader business into a separate bank account. So access to that bank account. Have all your copies of receipts because you might be asked by the tax man, but I would probably ask for some of the larger ones. So I've got it on my accounting records. With a limited company, again, because we work on a monthly basis, we get most people to plug into accounting software like Xero. So I've got all the records there. The things that we might need would be any additional spend that you've made personally from your own personal account. Other than that, because we try and keep in touch with people, we're on top of it.
Cool. Perfect. Tim, do you want some quick fire questions quickly to wrap this up?
Yeah.
Can you explain the importance of emergency funds in financial planning?
Yeah, so after wills and insurance, it's basically the most important thing. So you need to have a cash buffer in order to be able to have that parachute in case something goes wrong.
Yeah.
Be ill, you could be, lose your job, you could have an unexpected bill. There's no point in investing if you don't have that cash buffer.
So that's kind of the first step, is to make sure you have that fund before you start thinking about what else you're going to do with.
It's imperative.
Yeah. Perfect. And how do you approach educating clients about financial matters and investment decisions? How would you describe your mannerisms and how you speak to clients?
Down to earth. I always say there's no such thing as a stupid question. So literally having a chat with somebody and making sure that they're comfortable to ask me a question if they don't understand it. And so from there, I can then start to educate them and start talking about perhaps what's needed or how things work. And then if they don't understand that, they've got no issues and they're not scared to ask me a question.
Perfect.
Thanks for watching and tune in for next time.